Good morning and welcome this morning to Protective Strategies, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab, and I'm joined out there in the chat by my good friend, James Boyd, 20-plus year veteran in the financial market and a phenomenal educator. If you haven't had a chance to check out some of James's webcasts, please do so. He does a great job with the events and the topics that he has under his purview. So James is there to specifically answer your questions along the way in this discussion. And as we get started today, once again, thanks to all of you that are joining us in the live version. If you're joining us in the recorded version, welcome to you as well. We're going to jump into this discussion, and we've got a couple of things that I want to accomplish today. Number one, I want to manage some of the protective positions that we have on a couple of individual stocks, and then I want to look at another way that we might, in the situation of rising volatility or high volatility with the potential for that volatility to fall, how we might use index options as a means to hedge a portfolio or to offset some of that potential risk. So we're going to do that today as we get into a couple of these housekeeping items, though. Remember that everything we talk about simply for illustrative and educational purposes only. It is not a recommendation. It is not advice. And anything we talk about is simply for illustrative and educational purposes. Remember, when you talk about index and equity options, they carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. Multiple leg option strategy to involve multiple commissions. Spread trades must be done in a margin account. And remember that anytime you are short an American style option, there's the potential that that option could be assigned early. Now, in the Thinkorswim desktop software, specifically the Paper Money platform, which is what we're going to use today, that's a great learning environment, but it doesn't do some of the things that a live trading account will do. Namely, it does not facilitate that early assignment of short options. So make sure that you are aware of that. Make sure that as you move your practice from paper trading to live trading, you understand that that is a possibility that can happen. Now, we'll talk also about index options today and the difference that European style options have to American style options, so that we're aware of those characteristics. Also, remember that investing involves risk, including the loss of principal. Paper money is not a guarantee of future success out there in the real world. Technical analysis, probability analysis, fundamental analysis, those are all theoretical. None of those give a guarantee about what's going to happen. Now, we may talk about stop orders in this discussion as well. Remember that stop orders don't guarantee an execution price, just an activation price. In the event of a stop limit order, there is the potential for the price to gap around the limit area and that price not fill at all. Now, as we jump into this discussion here today, we're going to talk about some of the protective strategy that we've used. We're going to do a lot of application of what we have looked at before. But if you are brand new to this discussion, a great way to kind of look at this approach is that there are really three different there are lots of different ways to provide protection to a portfolio or to an individual position. But there are three different primary protective strategies that we talk about in this discussion. Callers, which is the purchase of a put option and the sale of a short call against ownership of underlying stock to provide a collar, or sometimes referred to as a risk reversal. But it's simply a way to manage and perhaps offset some of the cost of that protective put, which is the next strategy that we talk about. Protective put there to help gain value if the price of the individual stock goes down, or provide a precise level at which that stock could be sold. And then we talk about portfolio hedging, which is hedging a group of stocks as a whole using a common instrument, or an instrument that helps to reduce its sensitivity to directional price movement. So those are the three strategies that we're going to be focusing on. And as I do this, I'm going to shift over to my Thinkorswim desktop software platform. By the way, this is a good opportunity for me to remind you to click on that subscribe button down at the bottom of the page. That's going to make sure that you stay connected to the Trader Talks webcast channel. So go ahead and click on that subscribe button. If you haven't done so already, remember that you can also follow James and myself on X at Ben Watson CS. James is at James Boyd CS. I'll tell you what, a lot of great stuff going on out there in X. It's a great way to stay part of the community and connect with coaches in general and specific questions or topics that you might have in specific. Let's take a look at the SPX, see what's going on with the market today. Again, another day of kind of these up and down movements, kind of right along this level of support, kind of sitting in this particular case right around that 58.76 mark or so as a level of support. The RSI kind of breaking through this diagonal trend line, so maybe a little bit more weakness here as we go into kind of the midweek, perhaps doldrums. We've got geopolitical risk that has been stepping up. We've got energy prices that have been changing and showing a little bit of volatility. We see changes in interest rates, not necessarily coming from the Fed, but from bond movement that is having an impact on the market. And we see that the SPX, a little bit of a gap down sell-off today, but moving average is still holding up. RSI, however, weakening a little bit. The NASDAQ, a bit of movement today and a bit of hammer-like movement. If we look at the support here right around that 20,400 level or so, a bit of a push to the downside. We see that gap, a little bit of a gap to the open, and then a sell-off. Some buyers stepping back in, but not gaining full traction here. The RSI a little bit higher than it is on the SPX, not seeing quite the same break to the downside. And then the Russell 2000 small caps, after what was a pretty big bullish engulfing candle yesterday, seeing a bit of a pause. And the RSI just kind of languishing again, but not a lot of movement. Maybe kind of that wait and see now. And here's another thing to think about. Jim brings up a very good point. We've got NVIDIA earnings that are coming out tonight. So there may be a little bit of NVIDIA has been, quite honestly, and again, not for necessarily uncharacteristic reasons, but NVIDIA has been a fairly large driver of market activity in the past little while, right? And so this might be a little bit of a wait and see to see what's going on with NVIDIA, to see kind of that kind of bellwether, if you will, and if that will have an impact on, certainly on the NASDAQ, likely on small caps in that NVIDIA halo, and then a larger impact on the SPX as well. And so that's one of the reasons why perhaps that we're seeing a bit of a pause. The other reason is this. We've got a holiday week coming up next week, right? Traders are human. Institutional traders are human. The big travel pushes start this week. So you're going to see traders, you're going to see volume perhaps diminishing as we get into the end of this week. And you're going to start to see maybe a little bit less volatility perhaps, but a little less activity as well as the market kind of goes into that holiday mode. And that's going to last really generally through the end of next week as we get through that Thanksgiving week. So that's just the reality of the situation. Traders are human. They take vacations too. And sometimes they go to Florida. And by the way, you can follow us to Florida if you haven't registered for this already. We are doing a one-day market drive event this coming Saturday in Miami, in Aventura at the JW Marriott Turnberry. Great property. It's no cost to you. Come and join us. You can find that on schwab.com/events. I'll show you that in a little bit. All right. Let's take a look at the VIX just really quickly, kind of get a sense of what volatility is doing, because that plays into this particular discussion. Let's take a look at the VIX grid, and we can see that volatility has expanded in the last couple of days, maybe moving back a little bit closer to its average in this particular case, right around that 18 mark, kind of just tickling the 18 handle just a little bit. You can see what's going on with the market. We see the market movement, volatility increasing again, a little bit greater, perhaps increase than this pushback in the market would suggest. And that would also suggest that the VIX of VIX, the volatility of VIX, is increasing as well. So seeing a little bit more volatility than necessarily its typical variance would suggest. So becoming a little bit more volatile, and that may very well be because of that potential. I'm going to grab my single grid here really quickly, just kind of my playground, and we'll take a look at NVIDIA because you brought it up, because this does create a little bit of probability of some market movement. And you can see that NVIDIA kind of sitting here, kind of waiting to see. Now, by the way, this happens to be one of the positions that we have in our protective strategies group that we have managed previously. So a couple of things going on in this particular case. We see that the RSI, the relative strength index, kind of a measure of sentiment and momentum, has kind of backed off a little bit. We see a little bit of a squeeze here. Not necessarily a big giant divergence, because we see price kind of keeping an equal high or maybe a slightly lower high in this particular case. So relatively consistent with what price is doing, but a little bit deeper pullback in RSI going into the earnings announcement than we're seeing the pullback in the stock. So the stock's kind of coasting sideways at the moment, but momentum is falling off. Now, the other thing I'm going to add to this particular chart is I'm going to go up to that flask icon, and I'm going to add in here IMP implied volatility. So implied volatility, we would expect, has ramped up. And this is what's really interesting about this. That the overall implied volatility for NVIDIA, while it's sitting at the 61% level, which if we were to just have somebody tell us, hey, this has 61% implied volatility, we might think, wow, that's pretty high. But relative to where implied volatility generally sits, which on average is down around that kind of 48% level, that now perhaps that implied volatility is not quite as elevated as we have seen it prior to other earnings announcements. And there's kind of an interesting perspective to this, right? There's kind of an interesting perspective. Number one, there might be a lot of pressure to buy protective puts against NVIDIA long positions. But on the other side of that coin, because NVIDIA has a kind of generally higher level of implied volatility, those protective puts maybe have been kind of more expensive overall. So perhaps there's been a bit of spread type hedging, right? So buying and selling options to create a protective position, maybe selling a put spread, right, underneath to take advantage of that potential upside movement or to offset by bringing in a little bit of premium, selling calls or selling call spreads. And AP is bringing out, talking about, selling covered calls, for instance. And there may be a little bit of that. So when you've got selling pressure as well as buying pressure, that tends to keep volatility relatively compact. If we take a look at the trade tab and we come down here and we take a look at our today's options statistics, we can see that the current implied volatility percentile, even though this is a pretty highly watched earnings announcement, that current implied volatility percentile is only sitting at about the 48th percentile, kind of right in the middle. So volatility isn't very extended one way or the other. And we can see that if we look over here on the right-hand side, even though front month volatility or front expiration volatility is exceptionally high. That's what's triggering, by the way, the fact that we have this, when we have this contango, right, between front month or front expiration and next expiration implied volatility, in this case 146% implied volatility to the 82% implied volatility. It's that disparity or contango between those two that creates this market maker move or triggers this market maker move. That's where you will see that market maker move flag pop up on the trade tab, is when you see the front expiration implied volatility higher than the back month expiration, or the next expiration cycle. I keep referring to them as months. That shows you how old I am. That next expiration cycle implied volatility is lower, and that's where we get that market maker move. Now, this is the expected move, right? Based on the current level of implied volatility. So we look out 2 days to go, and this has an expected move of about 13%, or $13 plus or minus. Right now, this market maker move, because of the event that is set to occur, the stock has a market maker move of about $12 plus or minus. So that might factor into a protective decision. If a trader felt that the stock had the potential to move. Now, we've seen moves much, much larger than the market maker move, because remember, we said that implied volatility relatively constrained, even though in the front month or front expiration, it's 145%. This is not a huge move for this particular stock relative to its historical volatility. So hopefully that'll help to kind of get a sense of, one of the reasons why a trader might protect a position in a circumstance like this. Historical volatility, or historical volatility percentile, is about 18%. This isn't historically, from a movement standpoint, a very big mover, although it can be a pretty big mover at times. So let's go to our monitor tab, and let's take a look at our protective strategies group. And we do happen to have an NVIDIA position. Right, George, exactly, right? Implied volatility isn't based on historical. That's why I looked at both historical volatility, which is sometimes called statistical or realized volatility. It's what the stock has done, right? The implied volatility is the forward look of what the market expects based on supply and demand, purely supply and demand, right? The market makers are movement agnostic, right? Relatively delta neutral in managing their risk, but they recognize that the market isn't necessarily delta neutral. So there's going to be buyers of put options. There's going to be buyers of call options. There's going to be sellers of put options. There's going to be sellers of of call options. And so that supply and demand is where that implied volatility number comes from. Period. That's it. Right? Yeah. Here's the thing. It's a good idea perhaps to take a look at both of those, both historical and implied. But I don't know that there's a lot of benefit from trying to see if there's some kind of mispricing of implied volatility versus historical. Generally, historical will run lower than implied because of the potential for news. Historical volatility doesn't, already kind of incorporates that news, right? So here we are with an earnings announcement. That's about the newsiest news event that we could get. And so here we are now in this current circumstance, right? Okay. So let's take a look really quickly. And Mike, great question. One of the things that we're going to delve into as we continue this series in protective strategies is this understanding of implied volatility. All right, so let's take a look at this position right now, because this is one of the ones that I wanted to manage, because what we have right now is this long put at the 130 strike. Stock's currently trading at 144, right? And we paid for this long put, this long protective put, we paid $2.61. It's currently trading at $1.71. So what's happened is, even though the price of the stock has kind of gone sideways, right? Kind of really not made a big move, it's not really gone down either, right? We double check our chart here and we see, hey, you know what? There really has not been a big move to the downside in this stock, but there potentially could be, right? So given the fact that current implied volatility is so high, here's something that we could do in this particular circumstance, right? We know that we've got this earnings announcement coming up. We know that after this earnings announcement, there is likely to be a significant collapse in implied volatility. And there is the idea that historical volatility isn't very large, so we don't see a big move necessarily on the price of the stock. And nevertheless, we know that we've got a implied move of about $13 plus or minus. So if we were to say from here, let's call it 140, we're at 145, right? 145. Let's go 145 plus, we'll just call it $13.50 just for rounding. So that would put a potential move based on implied volatility in the next 2 days up to about $1.50 or 158 or down an equal distance. So let's just kind of draw this in. Let's go to 158. That's up around that 160 mark or so, right? And if we were to say, all right, let's go to the other side, 145 minus 1350 would put us down around 131. Well, we have that put option at the 130 strike, right? So we've got a put option right here at 130. 131 coincidentally, not so coincidentally, is a level of support, right? So that level of support, we're kind of right about there at that 131 level. We've got the 130 put option to protect us here, which still has a little bit of time left in it. It's become inflated because implied volatility has gone up a little bit. But here's something that we might think about keeping this rather than rolling, because if we were going to roll that long put option, this one right here, after the earnings announcement, we may not need that protection. We've already seen most of the time decay or the theta decay out of this, right? It's a little bit out of the money, so it doesn't have any intrinsic value at this point. So it's got all extrinsic value. But what we might do is bring in a little bit of premium. Let's turn this into a short-term kind of diagonalized collar to see if we can avoid perhaps the cost of rolling this out a little bit further, still leaving us with the potential, right, for 9 days to be able to sell the stock at 130 if, in fact, the stock makes a big move to the downside, right? That maybe is the benefit of the protective put. But let's go to the trade tab, and let's go to this high implied volatility, the one that's been jacked up on implied volatility right here to the tune of 146%. Let's see if we can sell a call option up around or outside of that projected move and use that premium that we're bringing in to offset maybe some of that cost of or that sunk cost of our long put option. So I'm going to go to that 2 November expiration, or that 22 November expiration. And I'm going to go out quite a few strikes here. In this case, I've got to go out probably 30 or 40 strikes. We'll go out 40 strikes, not 140 strikes. We'll go out 40 strikes, right? We'll come out here, we'll look at maybe selling that 160 call option, right? Selling the 160 call option. Now, we've got a long 100 shares, so we can sell this as a covered call. But remember, that 160 is right about or kind of outside that range of the projected move based on implied volatility. Now, could this stock make an outside move? Could news come out? Could there be something? Yeah, absolutely. But you know what? If that happens, and we now are forced to sell the stock $13 or $14 higher than where it is right now, and we brought in $1.60 in premium, okay, I'm fine with that in this particular case, in this scenario. So what I'm going to do is I'm going to look at this 160 strike, and I'm going to look at selling this 160 strike. Now, here's the thing I want to compare this to, right? So we're bringing in potentially $160 or $1.63 in premium for selling this 160 strike. I go back to my monitor tab, and what do I have left on this long put option? I got about $160 left on that long put. So basically, we are offsetting any remaining cost for this long put. and expecting that implied volatility is going to crush, that this option is going to expire worthless, that the price of the stock isn't going to make a really big move, because remember, historical volatility is pretty exceptionally low. It's down in the 18th percentile. There's just a lot of trading speculation going on, a lot of supply and demand for options, and so that's creating these inflated prices. So let's take advantage of it and providing a protective position. So we're going to go back to our trade tab, and I'm going to look at selling this 160 call option, okay? Selling this 160 call option, which we know is going to have a high level of theta because it's close to the mark, or close to expiration, which is great. But remember also, volatility sensitivity goes down as we get closer to expiration, right? So this is going to be primarily time sensitive. That's okay. It's got 2 days to go. We know that. So we're going to sell this for 2 days, bring in that premium at the 160 strike. And we're going to confirm and send. We're going to read through this order. We're going to make sure that this goes in the same group, that protective strategies group, so that we can see it. Now, because we have those other positions in that group, we're going to be able to see the relationship here. But otherwise, we know that in this same account, we've got 100 shares of long stock to provide us the cover against this short position. So I'm going to go ahead and click on send. After reading through that order, making sure that, wow, it looks like we may have to bump that a little bit to get it to fill. There it is right there. Let's right click, cancel, replace. Let's open that up a little bit, and let's give it a little bit. I'm willing to sell that at a limit price of 164. We'll make it a little bit less. We'll kind of come down a little bit so that we could potentially get this filled. We'll work this order just a little bit. Click on confirm and send. Read through the order again. Make sure that we're aware of any alerts that exist there. And we'll go ahead and we sold it for $1.63, which is almost exactly what we were still out on our long put option, right? So we sold that short call for $1.63. That offset most of the cost of that long put. So now what we're left with is nearly zero cost, even though we've lost a little bit. Right at the moment, this snapshot, this is a zero cost collar that we've got on the trade that will last for the next 2 days. It's a diagonalized collar because our long put has a different expiration date than our short call, which is good because the expectation here, we want this short call to expire worthless. We want all that premium to go away, either through theta decay or through the price of the stock never getting above the 160 strike. And that would then give us time for some protection to still be in place. We have the right to sell the stock at 130 if it were to go down. And that's not going to expire right away. That's going to expire 9 days to go. But it's something that we're going to have to manage next week as well, to see if that is working for us. Now, we've got a couple of other things here going on. We've got protection on General Motors. We've got this combo that's got about 16 days to go until expiration. So let's go to the chart here for GM. We can see that GM kind of did the same thing, right? It's pulling back a little bit. So our combo on GM, this collar trade that we have on GM, we have a 55 strike long put. Gives us the right to sell the stock at 55. We've got a 62 strike short call. So something's gone on here. The price of the stock's come down. Because the price of the stock's come down, our long put has gotten more expensive. We paid 55 cents for it. It's now worth $1.50. Great. We didn't expect to make money on that. That was there for protection. But the other thing that's happened is time has passed. The price of the stock's come down. So our short call has lost value as well. We brought in originally in that short call, we brought in 44 cents. It's now trading for a nickel. So we could close that out, and it's done some work for us. In fact, it's done the majority of the work that it could potentially do for us. It's done all but 5 cents of the work that it could do for us, that short call has. Now, we don't have an earnings announcement. Implied volatility is relatively flat. So here's the thing. Barring a news announcement, and to be fair, look, there's a lot of stuff flying around right now post-election about electric vehicles and about combustion engines and gasoline and prices, energy prices, all of that stuff. So it's not without risk of news, but implied volatility relatively low, relatively benign at this point. So what we could do is we could come back over here. Let's go to our monitor tab. We could close this caller down. And in fact, because we did it for an 11-cent credit, we could buy back this caller for a little bit of premium, right? Now, that sounds weird, right? Because in this particular case, buying it back, we're going to be buying it back for a credit. Wow, that's kind of cool. Right click, create a closing order, buy a combo. Now, here's the thing. We don't often get the opportunity to make money on a hedge. Callers are generally a sunk cost, right? If all goes well. But in this particular case, the things have kind of converged. The influences have kind of converged. Prices come back down. Implied volatility is stabilized. And enough time has passed that we've lost a little bit of that time premium here. So we're just going to buy this back for a credit of $1.48. I'm going to right click. We're going to create the order. And we're going to confirm and send. We're going to read through this order, make sure that we're aware of that characteristic. We're going to buy back that combo for more than we paid for it. What? We're going to buy it back for more than we paid for it? Wait, we're going to buy it back for a credit in this particular case because, the short side worked for us. The long side worked for us in this particular case and got more expensive. So this did what it was supposed to do. And we're going to go ahead and click on that send button, fire that order off. We'll see if we can fill this and get out. We might need to bump that and work it a little bit. So we'll go to our working orders and come over here and right click, cancel, replace. Let's open up our lock and let's give it a little bit here. Let's say, look, we're going to reduce that net credit. Let's reduce it right to the natural. Click on confirm and send, read through the order again. We'll make sure that that gets put back in our protective strategies. Click on send, fire that off, and we'll see if that gets filled. That may not get filled. And the reason that may not get filled, if we go back to the trade tab there for this one, is that short leg in this particular case may not have a bid. Right? So at the moment, it's 10 by 0 bid. And so that may be, in this particular case, a scenario where that it may take a little while for that to fill. But we're going to put that order out there. Now, Rich asks a great question. Well, wait, wouldn't we want to keep that protection on the downside? Oh, well, potentially. But here's the thing, right? If we go back over here to the monitor tab, we see, look, we put this trade on for a credit of 11 cents and we could get out of it right now for a credit of $1.50. Why wouldn't we want to get out of this for that credit, close it down, and then do it again? Because the protection, this is only going to get cheaper, right? We're only going to lose out of that long put option as we get closer to expiration 16 days from now. So why not take advantage of this circumstance where we could get a little bit of premium back for what we put into this versus what we put into it, and then put that protection back on. Remember, we looked at the chart and we said, you know what? It's sitting at a level of support. We don't have an earnings announcement coming up. There is the potential, but if we can close out of this and then at some point add another protective put, or maybe add another caller, maybe a low-cost caller or a no-cost caller at some point, yeah, Mike says take the money and run. So we're taking advantage of the opportunity that exists in this particular case. All right, one other one that I want to manage here. We'll leave that order out there and let that kind of work in our favor. And you know what? To be fair, we don't often get that, right? We don't often get that circumstance where we can close that trade down and make a profit. But here's another scenario that we've got right here, right? So we've got this is Coca-Cola. So let's look at the chart for Coca-Cola really quickly here. KO. Whoops, KO. Coca-Cola has been pulling back. We've kind of managed this as it's been moving down. It's kind of gotten to a level of support. We're past the earnings announcement. RSI is starting to rise. It's kind of gotten down to that over extreme. Implied volatility staying high, but relatively neutral at this point. So what we've got in this particular case is we've got a covered call or a short call option that expires in 9 days. We sold it for 20 cents. It's now trading for 7 cents. We've got a long put that was relatively cheap. That's got 30 days to go until expiration. That's at the 60 strike. So we look at the chart. Where's the 60 strike? Well, it's still down here below this level of support. So we're going to leave that 60 strike in place. But what I'm going to do in this case is I'm going to roll this short call because it's done all but 7 cents of the work that it can do for me. And so if this takes off and starts moving to the upside, I'm going to roll this call option out and potentially down a little bit, right? So the stock is currently trading at 62. I'm going to roll this from a 72 strike, which is 10 points out of the money, down a little bit, which means I'm going to pay 7 cents to buy this back, but I'm going to be able to roll this out a little bit, okay? Right click, create a rolling order. Now remember, rolling is not a magic wand in any way, shape, or form. It doesn't eliminate transaction costs. It doesn't eliminate those per contract charges or anything else. And it depends on the liquidity of the target expiration and strike. But it's a convenient way to accomplish this tool. So what we can do is we can roll this out maybe just 1 week, which is the default, rolling to the next expiration. I'm going to roll this out actually a little bit further because I know that in this particular case, we go back to the monitor tab, this expiration is the 20th of December. So I'm going to roll this into the same expiration month. So I'm going to pop that up. And we're going to roll this into the same expiration. So we'll roll this to the 20th of December. Rolling it to the 20th of December at the same strike yields nothing, no credit here. But if I roll this down a little bit, because that 72 strike call option for the 20th of December, probably fairly out of the money, probably doesn't have a lot of premium there, maybe doesn't even have a bid. So if we roll this down just a little bit, let's say maybe to the 65 strike, right? We're rolling down closer to where the price of the stock is, still with the potential to make money if the price of the stock goes up. Stock's currently trading at about 62 or 63. We've rolled it to the closer to the at-the-money position. So if this does start to rally, we could look at now either letting the stock get called away or buying this back and moving it again. But we're going to do it for about an 18-cent credit, which is going to eat away at the cost that it cost us to buy that long put to provide the caller. So we're going to roll this out for an 18-cent credit. We're going to click on confirm and send. We're going to make sure this goes back to our protective strategies group and make sure that we're aware of any alerts that exist here. We'll click on confirm and send, and we'll fire that order off. And we might need to work that and bump it a little bit. But what we're trying to do, roll these out to the same expiration so it's not diagonalized, bring in a little bit more premium, offset the cost of that long put, which is gaining value because the price of the stock's been going down. So we've adjusted that position as well. So we've managed a couple of these positions. Now, I wanted to get to one other thing here before we run out of time today. And that is, I want to come down to this particular group. And I'm just going to change this to just show my stocks group, right? So now what I've got is I've got a number of stocks in different industries kind of across the board. I think the only thing that I don't have, I've got a financial, I don't have any, I do have one healthcare here. I don't have any materials. I've got mostly information technology, some consumer staples, and I've got some energy in there, industrials, financials. I don't have any real estate. I don't have any utilities in this group, but so it's going to be a kind of a cross section, if you will. Notice that individually its sensitivity is about 2090 deltas, individual deltas. Remember, delta is sensitivity to directional price movement. So a stock has a delta of 1, right? Delta of 1 for a stock, because if the price of the stock goes up $1, the position gains $1. If the stock goes down $1, the position loses $1. So an individual stock position has a delta of 1. But now let's change this to a common coefficient. So what I'm going to do is I'm going to come up here and we're going to beta weight this, and I'm going to beta weight this to the SPX, the S&P 500. So now relative relative to the SPX, the common delta using the beta coefficient, how fast a stock moves relative to an index, a benchmark, in this case, the SPX. This position or this portfolio is sensitive to movement of the SPX to the tune of about, theoretically, $42. So if the SPX goes up $1, our position, our portfolio should gain about $42 theoretically. If the SPX goes down $1, our position or our portfolio should lose about $42. So not hugely sensitive, but a little bit sensitive. So what we could do is we could look at potentially offsetting some of that sensitivity because we've got the market kind of sitting at that. If we go back to our SPX here, SPX, market's kind of sitting at that support level and we're going into a holiday week, right? That being the case, we might put some protection on for the next couple of weeks simply to offset or reduce some of that sensitivity as there is some uncertainty existing. Remember, volatility went up. So here's what we're going to do is we're going to go back over here to the trade tab and we're going to bring up the SPX. Now, the SPX is a cash settled index, which means that you can't buy the SPX. You can have cash and trade the SPX, and those options or the index settles to cash. These options settle to cash, not shares of the underlying stock, because there is no underlying stock. It's an index, which is a group of numbers published by a company, right? So in this particular case, what we're going to do to offset that potential risk is I'm going to go out, in this particular case, a couple of weeks. I'm going to go out 2 weeks now. I'm going to go to the 4th of December. Actually, I may go to the 6th of December, which is a Friday. By the way, I will be in Orlando on the 6th and 7th of December doing a 2-day workshop, technical analysis on Friday and option strategies on Saturday. Come and join us in Orlando at the Orlando Marriott Orlando World Resort. Great property, pretty close to Disney, great place to be. Anyway, so let's take a look here really quickly at how we might do this. We're going to go to this 6th December expiration, and we're going to create, we could buy a put option, right, and offset some of that delta, because that's going to be pretty expensive, though. So look at this. We're going to offset all of that delta. If we were to buy, say, for instance, the 58.65 put, that's going to offset about our 42 or 43 cent delta in our overall portfolio. But boy, that's going to be expensive. So what else could we do to offset positive delta? Well, we could create negative delta by selling calls. So what if we were to create, let's offset by about half of that. I'm actually going to add some premium, some expiration, or excuse me, strikes here. Let's add another 30 strikes or so. And so what if we were to say, all right, let's go to the 40 delta call option here and look at selling the 46.70 call. I'm sorry, that's the 59.35 strike. We're going to sell that for $46.50, 40 cent delta. And let's sell that one. And then at the same time, let's buy the 60-20 call option. We're making a pretty wide, or 60-25. We're making a pretty wide short call vertical spread, but it's going to be left with a net delta. This is going to have a net delta of 20 cents. So watch this. When we create this order, right, we have the obligation to sell at 59.35, convert to cash. We have the right to buy, gain cash at 60.25, right, because it's a cash settled index. So big, wide spread, but we click on confirm and send here. We're bringing in premium to offset this risk for our portfolio instead of putting premium out. Now, we're going to keep this in the stocks group. We're going to click on send and fire that order off. This is relatively liquid, so we should get filled. We brought in a $31.20 credit. This has a net delta of about 20 cents, right? So we're going to go to the monitor tab, and we're going to go to activity and positions. There's our SPX. Notice that we reduced our sensitivity in this particular case to 2104. So we reduced our delta sensitivity by half, and we got paid for it. Holy cow. Reduced our sensitivity by half, and we got paid for it. That's one of the great things that you can do by understanding things like index options. Guys, if you want to learn a little bit more about this, one of the great places to go is right over here to the Trader Talks webcast channel on YouTube and type in index, and you're going to see information about index options. As a matter of fact, coming up after the first of the year, we're going to be teaching a class. I'm going to be teaching a class, theoretically, on index options. By the way, if you want to join us for those live events, go to schwab.com/coaching, click on in-person events, and there is your sign-up page right there. We've got a little bit more room. We've opened up some room in that Miami Market Drive. We've opened up some room in that Orlando workshop. So click on those sign-up buttons, sign up for those live in-person workshops. They're no cost to you. We're going to feed you. We're going to teach you. It's going to be great stuff, and it's warm in Florida. It's cold here in Utah, and boy, that's about all I've got today, guys. Hey, thanks, James Boyd, for helping to answer questions along the way. Thanks to all of you for being here with me, and once again, thanks to our great production staff for helping to make a great presentation today. We'll see you guys again very soon. Take care, everybody. Bye-bye.